on to the strategy. Because y'all be bugging. So to show y'all, this is what Top Step looks like on the computer. On the phone, you're only going to see the chart or your order log, which is this right here. This is your order log. And then this is your chart, right? Item, just so you guys don't get confused, right? So here, this is a great place to start with the strategy. This was the week before last week. Trump tweeted that him and China were at odds and he was going to put 100% tariff on them, this, that, and the third, and the market sank like a rock, right? Market sank like a rock. Then the weekend passes, Monday it opens, they're up again. And the reason why this is important is in order for you to understand what it is you're doing on trading, it's called the strategy. It's called ICC, indication, correction, continuation. That's all it is. Indication, correction, continuation. Where's my book? So it's not complicated, right? It's not complicated at all. And I'm not the founder of this strategy. I'm not going to take credit for something I didn't do, but I do study it a lot, right? I study it a lot. Why? Because it works. Therefore, the inventor of this strategy, his name is Trades by Side. There'll be times on the school community where I'll just, I'll have a random hangout and it'll be like a study session where I just, like, I'll look at the video and I'll be studying and I'll be talking over it and I'll just be like, I'll break down his breakdown, so to say, right? So basically an indication and a correction and a continuation is the entire strategy. That's all it is. That's why you don't need the extra indicators. You don't really need any of that. But the idea, let me go here to let me go down here. So strategy, if I can break it down real quick. We're already an hour in. I didn't think this would take this long, but here we are. So we are going to get started like this. So you have price, right? Price would start here and then it would rise here and then bounce back down here. And then it'll go back here and then back down here. And it'll just do this, right? The candles will just do this for a while, right? And then it'll break out like that. Bow. It'll break out like that, right? When price makes this, when price does this, this is called consolidating, right? It's just, it'll have, oh, it was a little bit, there you go. Right? So when price is here, it'll just do this for a while. It'll just trade in a zone. Like an example of that would be up here, right? It just traded in a zone. It's just not going up or down. Where's another example of that? Because we're in 1 hour, so we're going to jump to the 15-minute. So it looks like this, right? It's just trading like this, not up or down, right? Right? Like this right here, not up or down. Right here, not up or down. Or here, not up or down. It's just in one zone, in a straight line. It's just, it doesn't know what it wants to do. Or like right here, it's just beep, 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 beep. Same, it's just, you could box it out basically, but that's a consolidation. Right? So let me type this out. See you guys. This is consolidation. All right. Hello. Aló. ¿Está bien? All right. So you have your consolidation right here. This is what consolidating means. That price gets here and then it just bounces around. It doesn't go up or down. It just stays there. When it breaks that, so these levels right here, right? Like the peak here and then the peak here. This is your swing high and your swing low. So let's type that out. This is your swing high. Right? And then you'll have your swing low at the bottom. So you have your swing high and your swing low in your consolidation phase. So an indication, remember ICC, indication, correction, continuation. An indication is when price breaks a swing high or if it breaks a swing low. So price can either do this and that'll be your indication. It just broke these levels here and it broke that. That's your indication. Now you know where price wants to go, right? It's indicating its direction. That's why it's called indication. It's indicating its direction. Or it could have done this, and then this would have been an indication, right? It broke these swing lows and it broke below. That's an indication, right? It's indicating the movement as to where it wants to go. So we're going to go back here. This is your indication. A correction comes when price comes from up here, right? And then it corrects, right? So it goes here, it eats all of this, all of these people, right? So basically in an indication, I'll explain in a minute, but this is your correction. So you have your indication, it broke the swing highs, then it corrects, and then it has its continuation. Because that looks ugly. We're gonna do that again. All right, so you have your indication, your correction, and then your continuation. So you have your indication. Let me type it out right here. You have your indication, right? It broke your swing highs, indicating price is going to go higher because what price wants to do, price has a trend, right? You'll hear this a lot in the market. There's market trends, right? The trend as to where it's going, right? What we're trading here is market structure. So when it's in a trend, there's a certain structure that the market has that it's basically saying like, yeah, we're going to continue to go up because this is the trend, right? So the trends look like this. You have a higher high, like it makes a high, right? And then it has a higher low. And then it makes a higher high, and then it makes a higher low. And then it makes a higher high, and then it makes a higher low. And then it makes a higher high, and then it makes a higher low, and then it just continues, right? Let me fix that. Oh, it's a little ugly. There you go. But that's your trend, right? Market structure is the trend in which price is going. So whenever price breaks its structure, that means that it's going to change trends, right? So this is your trend right here. This is your trend, right? This is your trend. It's going higher, right? You have your higher highs right here. I mean, your higher lows, excuse me. And then you have higher lows right here, right? And it's making higher highs and then making higher lows and make higher highs, higher lows. That's your trend. So the same way it did higher highs here, higher lows. God, right? So you have your higher low right there. As soon as price hits here, right, and then it decides, we want to break the structure, right? You have a lot of sellers up here. Boom, price is gonna break its trend, break its structure. Excuse me. It's gonna break its structure by breaking below that swing low. It's gonna break below that higher low. When it breaks below that higher low, it is now broke its structure, meaning it's going to change trend. So now we made now we made a lower low than here. What we were looking for now is for it to make a lower high. So now it made a lower high. The next step, you guessed it, a lower low. And then you guessed it, a lower high. And then you guessed it, a lower low. And then you guessed it, a lower high. And then you guessed it, a lower low. So when price breaks its structure, that means that it broke the previous higher low and it made a new lower low, right? It made a new lower low. And then it made a new high, a new lower high. So as soon as it made this lower high, I would be like, all right, cool. Now we can set our position right here, right? It's about to break this low. Cool. Now we would set our stop loss above that higher low. Above that lower high, and you would just target the first, right? The whatever previous level you would have on your time frame. This is what that would look like. So you would see price made a lower high, and you'd be like, ooh, what's next? A lower low, right? So it made its lower high. When it breaks this again, when it breaks that lower low, that higher low again, then you set your entry point. You get in, and then boom, now you set your stop loss above that previous higher low, and you just wait out price, and it could keep going down. Price can go as far down as it wants until it breaks its structure and it makes a higher low, right? Until it breaks its structure and makes a higher low, then there is no reason for you to be fearful in your trade moving the opposite direction to which you want it to go, right? So that's essentially the entire strategy, but I want to go over it one more time. You have your swing highs and your swing lows, your swing highs and your swing lows, right? You have an indication. An indication is put it here. An indication is telling you the trend is trying to push in this direction, above or below swing highs or swing lows, right? An indication is price telling you we got power up here, right? So now, when it breaks a swing high or it breaks a swing low, right? Indications, you have to wait for the correction. Why do you need to wait for the correction? Well, I'm glad you asked. It's because corrections are not always going to go back to the previous levels that it indicated from. That's different. Corrections happens from the initial breakout to liquidate emotion, impulsive, and FOMO induced buyers or sellers, right? So corrections are literally for market makers to collect cash from people who got in. Like, let's say this indication happened, it broke out, boom, it was right here. There would be people that would get in. There would be people that get in right here, right? And they would have their stop loss like around here or whatever. And then you have your FOMO buyers, the people who are FOMO stands for fear of missing out, your traders that are like, oh, we ran up all this already. Let me get in now so that I can capture all the run that it's gonna have because look at all this momentum. Yeah, okay. Market makers are looking at that. So they want to liquidate, meaning collect the stop losses from these people, the impulse buyers and the FOMO buyers, and take their stop losses, because market makers make profits based off of the transaction alone. They have a commission, right? But on top of that, they need to collect capital in order to push price higher. So they need that correction to collect and then push price in the direction that they want it to go, or in the direction that it's insinuating that it will go. So corrections will collect the stop loss, because these buyers up here, where their stop loss would usually be like around here. So eat them, boom, they got stopped out. And then you got the impulse buyers that bought on the indication, which is something you should never do. And then they went all the way down up to here and liquidated them as well. And then it turns around and it starts pushing past this higher high that it made, because again, it created an indication. Then the correction was what? A higher low. And then it made what? A higher high. So essentially the strategy is you wait for a breakout from a swing high or a swing low, right? You wait for price to correct and go back to that range of your swing highs or your swing lows, right? And then when it turns around, now you get in right here. Because now when you get in right here, right? Now it corrected, and then you set your entry right here. What's going on? And you set your stop loss below. If I could just, there you go. Let me just move this real quick. There you go. So you would set your stop loss below the swing, below the higher low that it made, right? You would set your stop loss below that higher low. Oops. There you go. Below that higher low, right? And then you would have your entry point when it breaks back above those swing highs. And then price will go on to make higher highs because it had the indication. It already showed you that price can get up to here. So you can fuck around and just target this, right? It could be a 1 to 2. You could just get in, boom, you have your stop loss below the higher low, and then you just target the high of the indication, and then you're good, right? I do that sometimes. Then there's other times where I know there's strength, and I just leave it, and it'll just run and run and run and run and run and run. You can have a 1 to 4. You can have a 1 to 7 sometimes in some cases, which is a gnarly day. Let me tell you, crazy days like that are just, you're not there yet. But that's essentially all it is, right? I could go into all of this. I could, but you essentially got the gist of it. This won't be the only video I'll make on the topic, but for now, been here long enough. So remember, indication, correction, continuation, right? The indication is to observe. So observe the indication. Even if it goes $100 past that swing high, great. Now you know price has the capability and the strength to go past that previous single high by $100. You could just target the high of the indication and you're solid, right? But you observed, you waited. That's why alarms are important, because you'll be the impulse buyers. You'll be the FOMO buyers if you do not have alarms. Alarm goes off, boom, it just broke your swing high. The indication has been made. Great. Now you put an alarm for the same spot. The same spot, you put an alarm and you let it go. Probably a couple dollars above it. Give yourself some wiggle room, right? You leave it. You get an alarm again. Oh, it just corrected. You see the entire correction. You're like, damn, MFR was right. Had I been in that, oh my God, I would have been creamed. Oh, would have been creamed. But I set my alarms, right? I waited for the indication to do what it does, and then I waited for the correction to do what it do. It hit my second alarm. Wow, it corrected. It made a higher low. Oh my God. What next? You put your fucking entry. You get in position and you wait for price to go either to the indication high or past that. That's it. Bada bing, bada boom. You made some money. Now go to fuck home. Right? Or go to fuck to sleep. Right? Wherever the fuck you are. But that's the whole thing. The continuation. What the continuation helps you do is realize that you need that second move to confirm that price is on a downtrend or uptrend. Remember, indications will always create a new high or new low. You shouldn't be confused on if price is making an indication or not. Is it a new high or is it a new low? If it's not either one, it's not an indication. Right? So if it didn't break any of these swing highs, or if it didn't break any of these swing lows, then it's not an indication. That's why when you go up here, right? When you go up here, you can see these are swing highs, right? Let's go back to the 1 hour. It's cleaner. So, crucial rule. Oh my God, and I almost forgot. When you mark up your charts, oh, and I have it here too, and I'm bugging. When you mark up your charts, always only use the 1 hour time frame or the 4 hour time frame. What are time frames? Time frames are this. Each candle here, because these are what these are called, candles. These are candlesticks, right? Each candle is a certain time, right? So it takes a certain amount of time for each candle to close and for another one to begin. I trade the 1 hour and the 4 hour time frames, and then I look for an entry on the 15-minute or the 5-minute, meaning that if I go down to the 15 minutes, it's like imagine you're a surgeon, right? And you have a client on your table. You have the general idea of what's going on, but now you need to dive into the client. You have to open them up and you have to dive in and see what is going on. You have to get a better picture of what the inside is what's happening on the inside. So that's what it is. This is surgery. You start off. This is the 4 hour time frame. Your client is on the table. Now you have the 1 hour time frame. The client is now an incision has been made, right? You're cleaning out the blood, right? And you're seeing, okay, it's doing this, that, and the third. All right, cool, bet. Then you continue the surgery. You put a camera inside the body so you can operate with the little utensils. Now you're in the 15-minute time frame, and now you can see what is happening inside the 1 hour candles. Hear me, pay attention. I'm not gonna say it again. Now that you're in the 15-minute and you're inside the 1 hour candles and you can see what's going on, now you're like, all right, cool, I got a better idea. Depending on how it's different for every person. You can either just use the 5-minute or you can either just use the 15-minute. But regardless, those are your two zoom ins, right? That you can zoom in that much. So if you were to go to the 5-minute, now you see a lot more, right? You can see some lows right here. If it breaks past this low right here, then you know that price is going to make a lower low. And if it makes a lower high and it comes back down and it breaks that level again, you can deadass just put an entry right here and just try to target these areas right here. It is simple. Simple, simple, simple. Right? These time frames allow you to do surgery on the market. You can see what is happening, right? Go back out to the 15-minute. You can see what is happening. Go back out to the 1 hour. Now you have the general idea. See how I mark up my charts? Higher high, higher low, higher high, lower low, right? Lower high, higher low, because now we made a higher low. We didn't go down here and break below these levels. So we made a higher high, and then it broke past this level, meaning that it's going to go make some higher highs. And then it made some higher lows. Lower high, higher low, higher high. It just keeps going. It's a structure. When it breaks the structure, you can target the next one down here. You can target the next lows. When it breaks structure, you target what's next, right? But as you can tell, it has an indication, full indication, correction, continuation. Well, what do you know? Indication, correction, continuation. Indication, correction. You see these little candles right here? Correction, continuation. Even here, if you want to go back into the 15-minute, indication, correction, continuation. It's not rocket science. Indication right here, indication, correction, continuation. That's all it is, literally. But you mark up your charts, you mark up your highs and lows on the 1 hour or the 4 hour. You mark up your highs and you mark up your lows on the 1 hour or the 4 hour, right? Your highs, you mark it up, broke past it, continuation after it corrected. You can't see the correction on the 4 hour, so you go down to the 1 hour. 1 hour seems like, I can't really tell that much. I'm in the 15-minute. Oh, I see that it actually corrected. It broke above. My alarm would have went off. I would have set another alarm and it would have went off immediately. This is what I did. I got in here and I ran that up. It's easy. It's easy. As soon as you get it, trust me, as soon as you get it, you'll be like, I see now. That'll be you. Watch. As soon as you get it, you'll be like, okay. I see now. Anyways, that's it. Honestly. That's what trading that's what Top Step looks like. This is just so you guys can see. This is what Trading View looks like. Like, it has a couple more things. These are other indicators that I have. If I were to just hide this, and here, this is important. So right here, key levels by Spaceman. This is an indicator, absolute must for Trading View. If you had to have, because you can only have 2 on Trading View, only 2 indicators you need. Key levels by Spaceman, and then pivots, pivot points, high, low. So these are your pivot points. So you can understand, like, okay, I don't know where my highs are. I don't know where my lows are. It'll tell you right here. This is your high. This is your low. Right? Low, low. Your high right here. You don't need to do much. And then these are your sessions. So you see here, New York Open right there. This is the alarm, by the way. This is what it looks like. See, crossing 25,468. And here, Asia high. You got your London high up here, New York high. So basically, these are the highs of that session. These are the lows of that session. Let me put that right back there. Right? Your London Open, London low, Asia Open, previous day, the daily open, now what it opened on. This is when it opened right here for the day. It started here. All right? Previous week high. So it basically has the highs and lows of each session and the open. So like that, you know, what session am I in? It'll literally say it. It'll either, like, you won't see Asia or London. You won't see London or New York, excuse me, until Asia session is done. But you'll see Asia, and it'll be pushing Asia highs up and pushing Asia lows down, or whatever, wherever it goes. But these levels, these are your key levels. Key levels are absolutely important because you can target them alone. Like, this is a cluster. I call it clusters. When all of them are just in one spot, there's a higher chance that price is going to go back to these levels right here, which is why I have an alarm right there. And then this is another cluster. Price is going to come and touch this right here, right? Clusters for key levels are important because there's a density of activity there, right? So that being said, this is trading view. You know, you have your time frames up here, your indicators here. You have your alerts right there. You can add one if you want, but I'm not going to. You can also add it right here. See, add alert. I'm not going to. And then this is what your watch list needs to look like, right? These is all that you need to type in. So screenshot this. This is your heart. This is the market's heartbeat right here. You have your Dow Jones Industrial Average, which is the 30 industrial stocks in America. You have your NASDAQ 100, which is the 100 best stocks in America. And then you have your S&P 500, which is the 500 best companies in America. Then you have your VIX, the volatility index, must have. You have your 10-year treasury, right? This is what most auto loans and home loans are tied to, right? So the percent now is 4.0%. Then you have your dollar index, right? Your US dollar index. When this goes up, normally this goes down. So everything here, when this is green, usually this is red. And when this is green, usually these are red. The way they were, these only turned around because of this right here. But these were all red while this was green. That's why this is your heartbeat. This is your heart monitor. This is your, when you go into the doctor room and you see that, that's this right here. You can gauge the market's sentiment with this watch list here alone, right? I have my crypto, so Bitcoin, XRP, and then I have the stocks that I like to look at for my options trades here. So Nvidia, Microsoft, Apple, Amazon, Google, Meta, right? All these other companies here, McDonald's, JP Morgan, Roblox, Nissan, Home Depot, CrowdStrike, Palantir, Netflix, Coca-Cola, Tesla, Google, Meta, Amazon, you know. And then these are the ETFs, like the NASDAQ ETF and the S&P 500 ETF. But basically, this is what you need. When you download TradingView, just type in, like, you'll see this button on your phone or on the, like, if you have it on your laptop, you'll see it like this. But you press here, and then you just type in these. So YM1, you would type it YM1, and it'll pop up right here. And you just bloop, add it, right? You do NQ, and it'll pop up right here. You add it, right? See how it says the little thing right there? Add to watch list, you add it. So that being said, I think I'm gonna wrap it up right there.